All right, guys, welcome to number two. Hopefully, if you made it through webinar number one, you have a little bit of a better context of what the problem is with traditional finance. Because this webinar, this is all about the solution, right? So in the first webinar, we talked about the challenges and we talked about the need to do something different. Webinar two and webinar three is really the ultimate solution, and that will completely transform your personal financial plan no matter who you are. So this webinar, it's going to be about 20 minutes long, and it's going to focus on what I call the growing wealth stage of life. So if you're just starting out, this is a better way for most people to grow their wealth. The next webinar is going to talk a little bit more about how the same plan, the same concept works as you near retirement or already in retirement. So again, completely transform your financial life. A little bit of context first, and this is, this is how I refer to traditional finance. This is the education that I was brought up with. I was taught to go to school, get a job, take my hard-earned money, and put it in a 401k. And as we discussed in the last one, that doesn't work out very well for most people. Now, there are some people that have done pretty well doing that, but very, very few people. So why do so many people struggle financially today? For me, I call this goldfish advice. I call it, the traditional financial media, I call it goldfish advice. And if you've ever watched or read David Foster Wallace's commencement speech that he gave, I can't remember what school, but it was back in the 2005 timeframe, and he talked about goldfish swimming in water. And in fact, you know what? I'm going to cut to a little video clip, and we're going to watch the video clip, and then we'll come back and talk about what it is.
There are these two young fish swimming along, and they happen to meet an older fish swimming the other way, who nods at them and says, "Morning, boys, how's the water?" And the two young fish swim on for a bit, and then eventually one of them looks over at the other and goes, "What the hell is water?" The point of the fish story is merely that the most obvious, important realities are often the ones that are hardest to see and talk about.
All right, all right. So hopefully you got a better picture there. Most people don't know what they don't know. And the challenging thing with most financial advisors, they're well-meaning, good-intentioned people, but they're probably giving you the same advice that they are using. And that same advice that they are using isn't getting them the results that they want, but because that's all they have to share, that's what they share with you. It's the whole concept of what is water. We have to be able to look at the financial dilemma that exists today and not choose to opt into it and just try to find a way to do it better. Again, it's about doing it opposite, different, and that's really what this is all about. So most people struggle today because they just don't know what they don't know. You're watching this webinar because you're looking for something different. And so we're going to break away from the traditional goldfish advice, and we're going to look at how we revolutionize your financial plan. And what it really starts off with is it starts off with a concept that I call the core four. No matter who you are, and no matter what stage of your financial plan you're in, we want to set up a financial plan for you that will help you increase a couple of things inside of your plan and at the same time decrease a couple of things. So the first thing, and this is why I call this, again, the core four. This is how we evaluate every financial opportunity or decision that we have to make going forward. Because one of the great things about living in America, there is a plethora of opportunity out there. There are a ton of places you can put your money. But this is what we want to look at in terms of where we put our money. So the first thing that we want to increase is we want to increase your level of control. I want you in a position with your financial plan that you know exactly what you have, you know exactly how it works, and you have a good understanding of what the outcome of that financial plan is going to be. You're in a position of control. If we think about this for most people, most people's financial plan is built on hope. They have no control. They're hoping that the stock market goes well. They're hoping that their financial advisor has their best interest in mind. They're hoping that their asset allocation model has diversified them well enough that they don't experience a big loss. I mean, and the list goes on and on. Hope is a good strategy for Sunday, but it's not a very good strategy for a financial plan. So we want to put you in a position, first and foremost, that you're using tools that you control. The next thing that we want to increase inside of your financial plan is your rate of return. Obviously, we talked about in the first webinar, most people choose the market because they're hoping that they get a better rate of return. But the sad part about that is traditional financial advice tells you if you want a higher rate of return, you have to be willing to take more risk. I remember I told you a little bit, my first financial advisor that I had right out of college was my HR advisor, right? And I remember as I was picking the allocations for my 401k plan, I had no idea what I was looking at. I was looking at a sheet with all these little letters on it that represented mutual funds, and then the letters had numbers by them, and I chose the letters that had the highest numbers by them, right? I wanted to put my money in the funds that had averaged the highest return over a 12-month or a 24-month period of time. And little did I know at that time that really what I was doing is I was taking more risk. And many people tell me that I was young enough to accommodate that. If I lose it, I have plenty of time to gain it back. That is the exact opposite of what we want to do with the financial plan. We want to get you a higher rate of return, but at the same time decrease your risk. And there's a few ways that we're going to do this. We're going to talk about this here in just a minute. Last but not least, we want to eliminate, not defer, but eliminate one of the biggest risks to your retirement that there is, and it's taxes. And what we're told today is we're told to put our money in a tax deferred account, and that's advantageous to us because in the future, whenever we pull our money out of the tax deferred account, we'll be in a lower tax bracket. Now, think about how illogical that is. If you retire in a lower tax bracket, that means you retire poorer than you are today, and that's assuming tax rates stay the same. In the third webinar, I'm going to show you why that's mathematically impossible. But knowing that tax is an issue, we want to eliminate, mitigate, and get rid of that as much as possible. So the core four is, as you evaluate any financial decision or any investment, you want to look at how much control you have, what's your probable rate of return, how much risk you're taking, and what your relevant tax is. And the way to improve all of this is through education. So you are taking the time right now to improve your financial plan. But this kind of becomes a filter to say, if I don't have control in the investments, if my rate of return is based on me taking more risk, then this is probably not the right investment for me, and we move on, okay? Core four. All right, so let's go back to the savings dilemma, and let's talk about the third option, right? We talked about the first one is most people, they have their income that's coming in, they route out their expenses, they figure out a way to save money, they've got short-term savings which go to banks, they're planning on using their money, long-term is for retirement, right? They use the markets, and these two accounts function the exact opposite of each other. So what I'm going to introduce to you now is the solution, right? It's the way to make your entire savings plan more efficient, right? And the way we do this is there is actually an account that we can set up that will combine both your short-term savings goals and your long-term savings goals into one account, right? So in the short term, the two biggest things that we were looking for is we wanted our money to be safe and we wanted our money to be liquid. So the account that I'm going to introduce to you here in just a minute will keep your money 100% safe, and we'll talk about the type of safety that's different in this account versus the type of safety that's in banks, but it'll also keep your money liquid. So we're able to check off the box and say, okay, yep, we're hitting our short-term goals here. Now, can we hit our long-term goals? Well, in the long term, what we were hoping for is we wanted more growth, and that's why we chose the markets. So in this account, I'm also going to show you where your account will also receive growth. Now, this account's not ever going to do a 20% rate of return. We looked at what most people are getting in the market, which is not a 20% rate of return or an 8% rate of return. But today, these accounts are growing at about 5%, 5 to 6%, depending on your age. So right around there, and I'll show you how this growth works. But here's going to be the mind-blowing opportunity that we're going to talk about. You will also get the opportunity to make your money do two things at the same time. So think about this. We want our money to be liquid, and we want our money to grow. Now, if you put your money in an account today, and that account is giving you some type of a growth, your money is still, it's kind of stuck in that account to get whatever growth you're getting in that account. So let's say you decide to take your money out of the account that's getting you, whatever growth rate you're getting. As soon as you take your money out, the money is moved from a growing position to wherever you move it next. You can't continue to getting the growth and use your money somewhere else. Money can only do one job at a time for most people. So this concept, I'm actually going to show you how we can take your money and we can make it do two jobs, multiple jobs at the same time. So let's go into that right now. So again, I'm calling this cash flow banking. Probably my favorite name for this concept is infinite banking. Perpetual wealth strategy is one. There's a lot of different names that people give this. But basically what it is, if people are setting up the account the right way, we're using a life insurance policy. And when you hear about that for the first time, most people are kind of dumbstruck. Why on earth would I use a life insurance policy as an investment? Well, let's go through why people buy life insurance, and let's go through what we can do to make it different, right? So most people today, when they buy life insurance, they go to their insurance agent and they say, hey, I want to make sure if I die that my spouse is taken care of, that my business partner is taken care of, whatever it might be. And so they try to buy as much death benefit as they need or want. But because the only benefit they get out of that is if they die, they try to do it for as little cost as possible. Now, I'm going to tell you this statistic because I want you to know how good insurance companies are at doing this. But if you had to take a guess, out of all the insurance policies in existence today, how many of those policies do you think actually pay out a death benefit? Now, I've asked this question several times, and most people tell me 30%, 40%, 50%, 10%, whatever it might be. This is going to surprise you. It's actually less than 2%. So insurance companies are really, really good at what they do. If you have an insurance policy right now, think about it this way. You probably had a medical exam. The insurance company probably looked at your driving record, your medical history, if you're on any medications, they look at all that kind of stuff. They ask you questions about your family history, all kinds of stuff they look for. And insurance is all based on math, statistics, and probability. They look at that and they say, okay, a male or a female your age has an average life expectancy of XYZ, and you fit this risk profile in terms of your health rating. And they can determine with almost a scary certainty how long people will live. They don't know how long you will live or how long I will live, but they know how long, on average, people my age with my health live. So insurance companies are extremely profitable. Now, we want to approach insurance companies in a very unique and different way, and this is why it's called cash flow banking. We buy a life insurance policy completely opposite. We actually buy a policy that we reduce the death benefit down to as low as we have to have it. And this is actually required by the IRS if we want the policy to qualify as life insurance, which we absolutely do, and I'll explain about that here in just a minute. We buy as little death benefit as we absolutely have to keep it qualified as life insurance. And really what we focus on is we focus on your savings goal. And that's unique to every single person, right? Some people put in $10,000 a year into these policies. Some people put in $500,000 all at once and then never put any more money into it. So the savings goal is really up to you. How much money do you want to put in? Where are you currently putting your money? And is it better served in an account like this? So we set up a policy to build it around your goal, the amount that you want to put in. We buy just enough life insurance to keep it qualified as insurance. And then this turns into a completely different type of an account. So let's talk about what this account is and how it works. Okay. We build a policy that is focused on one thing. It's focused on what the insurance companies call cash value. So the way this is set up, again, we pick your savings goal, whatever you want to put in. We build a policy and we use a company that will give you 100% control. And going back to the beginning, you'll know exactly how your plan is set up. You'll know exactly what your plan can do. You'll know exactly how you can use your plan, and there is no variation from that. In fact, these are literal contracts that are set up to where the insurance company will say, okay, client, A, you get XYZ and you'll get that for the rest of your life. We focus on what is called the cash value. And the cash value inside of an insurance policy, think about your IRA. The money that you have in your IRA represents the investable portion, the investment portion of your IRA. The cash value is the same thing. It's a policy, and inside of your policy, the majority of what we're putting into it is going right towards cash value. So as that builds up, I'll show you this here in just a minute, it really is just a function of what you put in. So here are the benefits of having a policy set up in this way. Number one, you will get a guaranteed rate of return. Now I know that if you're hearing about this for the first time, that might sound kind of crazy, right? There's very little guarantee today in most financial tools. But the insurance company will actually stand behind this and say, okay, client A, you will get a guaranteed rate of return for the rest of your life, as long as you live. It's pretty crazy. Most insurance companies today are guaranteeing 4%, okay? On top of this, you will get a dividend. So the dividend, the type of insurance companies that we use, they're called mutual companies, right? And all this really means, most companies today are stock-based companies. You can go buy a stock in Apple or in many insurance companies today, and you don't have to be an owner of the company. You don't have to be an employee of the company or anything like that. And every quarter they report their earnings, and if their earnings are up, your stock went up. A mutual company is not a publicly traded company. A mutual company is a private company owned by its policyholders. So the policyholders, the people who actually have these type of policies set up, own the company. And every single year, the insurance company returns its profit in excess of its expenses back to its policyholders in the form of a dividend. Now, the companies that we use have been doing this for 100+ years. In fact, one of the companies we use has paid a dividend now for almost 200 years straight, every single year. 2008, the early 2000s, the Great Depression, World War, everything included. They have always been profitable. They have always met their guarantees. They have always paid a dividend. That's a pretty amazing track record. And what this leads into next is your money is 100% safe. The easiest way to think about this is it's a private contract between you, a private individual, and a private life insurance company. We qualified as life insurance, remember, so all of the growth, and this is the big reason, all of the growth that we're getting is growing and is accessible to you tax-free. Now, this is a huge, huge thing. We're not going to talk as much about this particular aspect in this webinar, but in the retirement webinar, we're going to talk a lot about taxes because that's one of the biggest issues that retirees face. But here's where it gets fun. Your cash value is liquid, okay? And this liquidity is used primarily in two ways. To start off, most people use this like a bank. Hence the name, what did we call it up here? We call it cash value banking, right? It's not really a bank, it's a life insurance policy. But we're going to use a similar strategy to a bank, and so that's why people call this a bank. What this will essentially do, and I'm going to explain exactly how this works, it will give you the opportunity to make your money do two things at the same time. So most people start off there. Now, whenever you're ready, you can also use your policy like a stream of income, taking distributions from it. And oh, by the way, do any of these benefits, do they have anything to do with you dying? Right? We're talking about this being life insurance, but this has nothing to do with you dying. So if we set up the policy in the way that we've talked about, we focus on what are called the living benefits. We set up a policy that you use the entire time you're alive, but it will still have a death benefit. Now, that's not the focus of the policy, especially in the beginning, but you'll still have a death benefit as well. So let's go into a little bit more detail and talk specifically about how the policy works as a bank. But think about it this way. Let's say you've got money inside of your policy, and let's just say, for example, you've saved up $50,000. And what you want to do now is you want to become a real estate investor. I can't tell you how many times I get people coming to me saying, I want to invest in real estate, I just don't have any money to do it. And we look at their financial plan, and most of their money's tied up and locked up inside of a 401k. So the very reason, or the very thing that they want to do, they're preventing themselves from doing it by where they're putting their money. Their money's locked up. In a policy, if you have $50,000 of cash value, let's say you decide to go out and buy an investment property. That $50,000 is now working inside of an investment property, earning a rate of return there, but you'll still get your guaranteed rate of return and your dividend on the full $50,000. Your money's doing two things at the same time. So think of the options with this. You could use this for real estate. You could use this to run and start a business. You could use this for family travel, put your kids through college. The list goes on and on. You are 100% in control of what you do with it and how you use it, okay? So let's talk about this concept of controlled leverage. Most people today, they can only do one of two things. If I came to your house and I gave you a $100 bill today and I said, I don't want it, you could have it. What can you do? You could spend the money, right? You could go out and use it and go out to dinner, or you could save the money. But those are the only two options. If you save the money, that means you can't spend it, and if you spend the money, that means you can't save it. $1 equals $1. What if I told you that you could spend your money and still grow your money at the same time? So how does this work? Let's just go through a really quick example around this part right here, and then we'll show you how the policy works. So think about it this way. I'm going to draw a line here, and this line is going to represent kind of a $0 break-even line. And let's just say every year you like to travel. For me, this was a huge, huge benefit for me once I found this concept. In fact, permit me here for just a minute. My wife and I, when we were first married, we had really big dreams, right? We got married our senior year in college, and we had really big dreams. We were going to do all this amazing travel and go all across the world and do so many fun things. And it sounded all really nice when we were in college and too poor to really do it. And I remember once we got out of college and we started working, we were still too poor to do it. But I had the money to do it, right? But I got so focused on saving money that every time we spent money, even though I had budgeted for it and I had the money set aside, I always felt guilty about doing it. I felt like I wasn't achieving my investment goals. I wasn't saving enough. I shouldn't spend money. Let's defer all of our enjoyment and we'll spend money and travel later when we have enough, right? That was kind of my mentality. This was a really hard mentality for my wife because she's really good at living in the moment. And we struggled with this all the time. Every time we spent money, I would, groan and complain about it. And so it wasn't really enjoyable for me. Now I'm going to show you the solution. I'll come back and I'll finish off this story. But here's how we do it. Let's say that we budget 2,000. I don't know. Let's just say $2,500 a year. Let's say we want to go $2,500 a year to go on a vacation. The way this works is if we're going to use cash, right? We kind of save up our money over a period of time until we get the $2,500. We take the money out then and spend it, and we're back down to $0. Now, if we know we want to go on a vacation again next year, we do the same thing over again. We save up the money and then we spend it, and we do this over and over and over again. Think about your own personal finances. How many expenses do you have that are reoccurring expenses that you have month after month, year after year, from holidays to travel to car payments to buying homes, everything in between? Now, if we don't use cash, then we use debt, right? And debt is really just the other end of the coin. We spend the money first, and then we spend the next amount of time paying the money back. But in either case, we end up in the same spot, right? We're back at $0. So how do we make this better? How do we spend and use our money, but also grow our money at the same time? Well, this is the cool part. Inside of your policy, you actually have the opportunity to use what's called a policy loan. This is a guaranteed part of your contract that you'll get for the rest of your life. Now, your policy, we're going to represent this over here. I'm a visual person, and so let's say you've got your policy and you've got cash value in it. And let's just say for this example, let's say you've got $25,000. Now I'm going to give you a really basic example, and then we'll kind of expand on this here in just a minute. But let's say it's time to go buy a car, okay? And right now we know how the car purchasing system works, right? You either have to have your money saved up or you have to get car financing. And when you get financing, you have to go to the bank, you have to fill out an application, they look at your credit, they kind of treat you like a criminal. And then at the end, they come back and say, okay, yes, we'll give you financing, but here's the conditions, and if you don't meet the conditions, you're in big trouble, we do X, Y, Z. So they're in control, right? Your policy is going to give you a third option, and that third option is you can take a policy loan at any time for any reason. So let's say in this example, the car is going to cost us $25,000. So what that means is we'd have to have $25,000 of cash value inside of our policy. We can only borrow what we have cash value inside of the policy. But here's the cool thing. The loan for the car, it's not going to come from our policy. It's literally going to come from the insurance company, right? The insurance company, they already know, they've set this up in the policy, they already know that they owe you money. So what they're going to do is they're going to use your policy as collateral. And what that means is if you took a $25,000 loan today and you walked out and got hit by a bus tomorrow and died, the insurance company would pay out your death benefit minus your outstanding loan. So they know they owe you money. They use your policy as collateral. But here's the cool thing. The insurance company will never ask you why you're taking a loan, what you're using it for, when you're paying it back. They're not going to ask you what your credit score is. They're not going to make you set up minimum payments. You are 100% in control of the loan. So the loan comes directly from the insurance company, but you're in control of it. So I'm going to give you a cheesy line here. I like to think of this process as kind of like a quote from Spider-Man. So if you've ever watched the movie Spider-Man, when Peter Parker gets bit by the spider, right, and he's sitting in his cab or in his uncle's cab, his uncle realizes that something's going on with Peter, and he says to Peter, "Hey Peter, with great power comes great responsibility." Peter has all this new power, and his uncle's trying to tell him, even though he didn't understand the power that he had, with that power, you've got great responsibility. And that's the exact same principle inside of taking a policy loan. You have all the control, you have all the power, but we want to use it responsibly. And if we do this, here's the benefit. So let's say that we decide we're going to treat this policy loan just like a car payment, and we're going to pay it off over 5 years, okay? Now, the insurance company is loaning us the money, so they're going to actually charge us an interest rate. Today, the interest rate is around 5%. Now, this is where people on the surface will say, that's crazy. Why am I going to pay the insurance company to borrow my own money? Well, remember, we're not borrowing our own money. We're borrowing the insurance company's money. And the insurance company, we want them to be profitable. Remember, when we took out this policy up here, we took out a private contract and we actually became an owner of the insurance company. And part of our profit with the insurance company is we get a dividend based on their profitability. So coming back down here, let's say that you have a policy and I have a policy with the exact same company. If I take a loan every single month and you never take a loan, if the insurance company can't recoup some of their profit that they're losing on the money they're lending me, then they're losing money and all of our dividend goes down. So the insurance company is simply going to replace what they would have been earning elsewhere with the interest rate that they charge me on the loan. And today, like I said, with most insurance companies, it's right around 5%. Some are a little bit higher, some are a little bit lower. But let's use 5%, okay? Now, we want to treat this like a car payment, so we're going to pay this back over a 5-year period of time. And the reason I've drawn the triangle like this is the loan that we take from the insurance company is a simple interest loan. Now, if you don't know what that means, let me just bring up a calculator here and let me show you how this will work, okay? All right, let's make this a little bit bigger. Okay, all right, here we go. All right, so what I did is I put in a $25,000 loan, and I put that we're going to pay it off over 60 months or 5 years. We're just going to treat this just like a monthly car payment. And here's the math behind what we're charged and what, how the loan works. So if we wanted to pay this loan off over 5 years, we would need to make a payment of $471.78. Now remember, the insurance company doesn't ask you for this payment schedule. They don't make you stick to the payment schedule. You're in control of that. So if you make the first payment and then something comes up and you skip the next 3 months and you start up again, no big deal. If you make a payment today and then, 2 weeks from now you decide to throw another $1,000 at it and then $200 after that and then zero for the next 6 months, again, totally up to you. But here's how the math works. The first payment that you make, out of that $471, $367 would go to principal. It would literally pay down your loan. So the $25,000 loan goes from $25,000 down to $24,600. But $104 went to interest. That's a cost. That's a charge to you and us. It went to the insurance company. It's recouping the profit. Recouping the profit that the insurance company would have earned had they had their money invested elsewhere. But because your loan balance went from $25,000 down to $24,600, the next payment that you make, you're being charged interest on a smaller balance. So a little bit more of that payment went to principal and a little bit less went to interest. And you'll see how this works. Every time you make a payment, more of your payment goes to principal, less of it goes to interest. And over this 5-year period of time, if you follow this all the way out down here to the bottom, the last payment that you make, $469 goes to principal, $1.96 goes to interest, for a total interest expense over this 5-year period of time of $33.07. Okay, so $33.07. Let's close out this calculator here. Boom. All right. So we're gonna put this right here, $33.07. We're gonna put this at cost. And the reason I draw the triangle like this is it kind of represents the way that interest was flowing. In the beginning, more of our payment was going to interest, but every time we made a payment, less went to interest, more went to principal. This cost went back to the insurance company. Okay, so is there any benefit for doing this, right? Here it is. Our $25,000 never came out of our policy, right? We had the ability to use the $25,000, so our money is doing two things. In this case, we used the money to buy a car. We drove the car, we had a great time, we got everything out of this transaction that we wanted. But our money never came out of our policy, which means it continued to compound over this same 5-year period of time. And compounding works the exact opposite. That's why the triangle is the other way around. It works the exact opposite from simple interest. But here's the interesting thing. We're going to be compounding at the same rate that we're earning. So the same rate that we're paying. If we're paying 5% on a policy loan, that means we're earning 5% on our policy. And if we look at that on the surface, most people would think, man, there's no advantage to that. I'm earning and paying the same thing. There's no advantage to that. So let's go through the math and let's kind of prove this out. All right, so compound interest works the exact opposite. So 5 years we have the loan outstanding in this example. We're earning 5% on $25,000. The first year we earn 5%, which means we earn $12.50. That $12.50 is paid out in the guaranteed rate of return and the dividend. It's now rolling into our account. It becomes part of our contract. We'll never lose it. And so now in year number 2, we're earning 5% on $26,250. So because it's a bigger balance, we earn a little bit more interest. And you can kind of see the way this is going. Every single year, our balance gets bigger and bigger and bigger because of compounding, which means our subsequent interest earnings gets bigger, and it just grows upon itself. So if you had your policy loan outstanding for 2 years, for 10 years, for 5 years, or any amount of time, as long as you're treating this responsibly and following the strategy, you come out ahead. What did we say we were? Let's just put that number back up there. So we would have earned 6907 in this example, right down there at the bottom. Okay. All right, so 6907. Let's put this as our profits. Okay. And we can kind of see the compounding worked the exact opposite. It just got bigger and bigger and bigger every single year. So the exact opposite, and here is the magic, right? Our money did two things. We bought the car, it continued to compound, and in this example, we came out $3,600 ahead. Now, $3,600, that in the beginning might not sound like a life-changing, life-altering experience, but let's actually just think about this. Let's say that you're a young person, age 30, and you plan to work and have an income coming in for the next 20, 30 years, right? Could you not use your policy over and over and over again and use it for vacations, use it to buy rental real estate, start a business, and still have the same compounding? So let's just do the compounding just on this $25,000. And let's say we compound this now, let's just say 35 years. Compound this for 35 years, okay? So now, again, $25,000 compounding at 5%, it just gets bigger and bigger and bigger. And in this example, the $25,000 grows to $137,000. All right? Now, if that money was anywhere else, right? If that money was in a 401k, it would have to stay in the 401k. And if you decided to buy a car or go on a vacation or do anything else, you'd have to come up with other money to do that. But with this strategy, right, our money's doing two things. We're going to get to this $137,000 whether we use the policy or not. But now, can we not use the policy over the same 35-year period of time to create all kinds of other things? So going back to my vacation experience, in the beginning, when I was really hard about spending money, my wife and I, we lived in Dallas at the time. And we booked a vacation, and we decided to go from Dallas down to San Antonio and go to SeaWorld. The trip was going to cost us about $2,000 total, so not terribly expensive, but I was all stressed out about it. In fact, we booked a hotel online at one of those online booking sites, and we booked the Hampton Inn. And I remember we looked at the Hampton Inn, it was going to cost us $80 a night. It was pillow top beds, free breakfast, all that stuff, right? So we're like, okay, let's do it. I was stressed about it, and so after my wife went to bed, I did the stupid thing, and I went back on the hotel booking sites, and I canceled the Hampton Inn, and I found a hotel that looked good on the pictures, but it was half the price. So I thought, okay, this is great. I'll save half the money, and I'll book this other hotel. So the day of the trip comes, and we get in the car. We're driving down to San Antonio. We had our first son at the time, and we're stopping at restaurants, and I'm kind of telling my wife, hey, let's just share a meal. Let's not buy drinks or anything like that. Let's be cheap. And so I'm stressing her out, right? Even though we had prepared for the trip, we had the money. I'm stressing her out because I'm stressed out. And when we got to the hotel, this is where I knew I was in trouble, right? So it was perfect setting. The sun's setting, and we pull into the hotel, and she immediately recognizes it's not the Hampton Inn. And this hotel, it looked like something that you would pay for. Definitely, it was rundown. That's the way I'm going to say it. It was just a rundown hotel. We got in the room, and there were cockroaches in there, both dead and alive, and it was horrible. And she started to cry. And I remember I felt trapped at that point because I didn't know what to do. I didn't know if I should just throw my savings goals in the trash and just spend money recklessly, or if I should just say, look, we're just not going to travel. We're not going to do this. We're going to wait until we're retiring or something like that. So I'm going to fast forward now. I use this concept, and I've used this strategy now over the last 9 years. And I'll tell you what, this has completely changed my life. And the reason it's changed my life is because it allows me to utilize my capital today to create life experiences. So my family and I, my kids that I showed you on the first webinar, we just got back from Mexico. We had a fabulous time. We stayed at a nice hotel. We ate good food. We did all kinds of excursions from what is it called? Parasailing to scuba diving and snorkeling. We did all kinds of things. I budgeted for it, so this doesn't give me the permission to spend more than I should, but what it did give me the permission to do is to utilize my money today to create life experiences, but also have the peace of mind of knowing that as long as I follow the system, my money is still growing and compounding. So that's kind of my personal story with it. I'll tell you a little bit more about this. So let's go into this. And I wanted to show you just a closer look, okay? So I ran an illustration with one of the companies that we do some business with, and I started with a person age 30, and I said, okay, what if this individual saves $15,000 a year, right? And I ran it, and I cut off a little part here, so I could show you what happens at 65. So if this individual saves from age 30 all the way to age 65, in this policy, look what they're going to have. Right? In the very beginning, they have $11,000 of cash value. This is the money that they can use outside of their policy for vacations, to buy rental real estate, start a business, whatever it is. This is the money that's also earning an interest rate and a dividend. So effectively, this is the money that's doing two things at the same time. Now, I'm not going to go into the details of this illustration. It's easy to see there's a difference between what they put in the first year and what they get out. The rest of that money is showing up in death benefit. We set this policy up, though, by the third premium that they put in. This is when we overcome the cost of insurance. And all I mean by that is in that year, when they put in $15,000, their cash value goes from 24 to 40. So in that year, everything that they put in, their policy went up by $15,000 that year. Everything that they put in shows up in cash value. And from that point on, that remains the case. So if this individual keeps putting in $15,000 every single year, at age 65, he or she has almost $1.7 million. That's a pretty decent amount, right? Almost $1.7 million. They have a $3.2 million death benefit. They've been able to use the value of this money all along as a bank to create other experiences and do other things, which we'll talk more about here in just a minute. And they're still going to get there. And oh, by the way, that money's tax-free. So hopefully you can kind of see that the options here are limitless. We can do so many things with this. We're in control of it. It functions as a completely different financial strategy, different than a bank, different than the market, obviously, for sure. But it's something that will give you a better foundation to build on. So let's go one more thing here, okay? So in the first one, we talked about compound interest, right? I'm going to bring compound interest back. Compound interest, this is represented by the cash value inside of your policy. And remember, up here in this example up here, I kind of walked you through the step process. This is how most people handle their finances. If they use debt, they spend the money first and then they pay the debt off. If they use cash, they save up the money and then they spend it, but they're always back at zero. If we have a better strategy now, could we not take our money and put it in a policy, have that policy compounding for us, and take a loan, right? Take the loan, go on a vacation, go buy a piece of rental real estate, go do whatever you're going to do, and then spend the next amount of time paying the loan back. But here's the interesting thing. Rather than being at $0 where we would have been, we don't break compound interest. And in the beginning, that difference is kind of small. But as we do this over and over and over again, we can kind of see the way this works, right? We can use our capital over and over and over and over again. And my stairs are getting pretty sloppy here, so hopefully your loan repayments are a little bit more clean than these stair steps. But nonetheless, we're going to get to the same spot. So imagine what you could create. Imagine what you could do if your money did two things for you. If it accomplished your short-term goals, whatever those might be, and your long-term goals of having your money compound and grow. Would that not change everything? One other thing I want to put in here is the value of a guarantee. So I just pulled one of the track records from 1960 to 2012 of one of the insurance companies that we represent. Every single year, this is the amount of dividends that they have paid to their policyholders. So 1960, dividend. 1972, $123 million in dividends. 1979, $249,000. What is it? 2000, right? When the market was crashing. They still paid a dividend. 2008. Wow, look at that. Still got a dividend. Every single year for almost 180 years now, this company has paid a dividend every single year. There's some reasons behind that. These insurance companies, they invest differently than the average person. They don't invest in the stock market. How can they invest and gamble their money away and then turn around and make anyone a guarantee? Insurance companies, just like what I talked to you about in the beginning, they only invest in things that they can control. That's the only way they can make any type of guarantee to you and me. So what would the value of a guarantee do to your financial plan? Rather than having a financial plan always built on hope and always built on uncertainty, what if you could approach retirement with confidence, knowing what you have, knowing how you can use it, and knowing what it's going to do for you? The value of a guarantee, the value of certainty, I cannot quantify that for you, but it changes everything. For me, when I decided to get out of the market and to get out of 401ks and all of that kind of stuff, I was nervous at first, but as I started doing this, and I've done it now for 9 years, as I've done it and seen the results over a prolonged period of time, I can't tell you how much confidence I have in my financial plan. I've used my policies for everything from buying real estate to funding vacations to funding an emergency heart surgery on my oldest son. I know what I have and I know how I can use it. So here's the last part of this webinar. We talked about this phase of life, growing wealth. Now, whether you're down here and you're just starting out or you're up here and you're getting ready for retirement, your financial situation is going to be a little bit different. A lot of the people I talk to come to me right here. And, they're in their 50s and they've followed traditional financial advice for the majority of their working career. And they're now starting to scrutinize and look at their financial plan a little bit more closely because they realize they're getting close to retirement. So this is a challenge for people, right? If they're looking at their 401k and they realize they have a fraction in there of what they thought they would have and what they will eventually need to be able to retire, how do we bridge the gap? How do we get them from where they want to or where they are now to where they need to be to cross this threshold and be able to retire? This is probably one of the most exciting parts of this concept. And it works whether you're down here or up here. A lot of the younger people that I talk to, they see, the way things are working for their parents and their older coworkers, and they want to do things differently. So what I tell people is, man, if we use this strategy, we can actually achieve financial independence in 10 years or less. I know this because this is what I've used in my life, and I've helped several clients restructure their finances to be able to retire earlier, maximize income, or even achieve financial independence. And it's very, very simple. Let's talk a little bit more about this, okay? We talked about the policy, right? And the policy has cash value in it, right? And that cash value can be used in one of two ways. And this is kind of the mental game I play with myself every time I take a policy loan. So we can use our policy like a consumer. And this would be for things like we could use it for a vacation. We could use it to buy a car. We could use it to remodel our kitchen, right? We could use it for medical expenses, whatever we're going to need over here. And the reason I call this a consumer, these are all things that we need to do, we want to do, and we should do. And we should definitely think about using our policy for this stuff because this will make our finances more efficient. Now, when I do this, I do it just like I told you before. I treat it just like part of my budget, right? If I'm going to take a vacation to Mexico, when I took the vacation, I budgeted it out. I figured out, okay, I'm going to pay the loan off over 12 months so I can use the money again next year for another vacation. And when I budgeted it out, I could afford to make that monthly loan repayment. So again, it doesn't give me the permission to live beyond my means, but it does give me the permission to utilize my money more effectively. So I pay this just like a budget. It's part of my monthly expenses. But the reason I call this consumer stuff, a vacation at the end of the year, it doesn't put any money in my pocket. It's an amazing investment, but I don't make any money on it. The same for a car, the same for a home remodel, medical expenses, all that stuff. I'm not making any money on that. So if we want to bridge the gap and if we want to achieve financial independence faster and more efficiently than using traditional financial strategies, could we not also use our policy like an investor? And as an investor, you could use your policy to buy gold and silver. You could use your policy to run a business. For me, my biggest thing was when I came to this concept and found this concept, or was introduced, I guess is a better way to say it, to this concept, I wanted to buy rental real estate. I was introduced to this concept by a mentor of mine who was teaching me how to buy rental real estate, get out of the rat race, stop doing 401k, all that kind of stuff. Now, think about it this way. What if I use my cash value and I buy an asset? Now, there's some education that we need to do around rental real estate, and I had that education, and so I was buying assets that produce cash flow, right? So now my money is literally growing and working inside of real estate. But remember, I took a policy loan, so my money is still working inside of my policy as well. I'm earning an interest rate and a dividend, and now I can take this cash flow and I can use it to pay back my policy loan. And once I've done that, here's the cool thing. My money's now growing. It's working in two places at the same time. Once I've paid back the policy loan, I still have the home. It's still cash flowing. So why don't I just do it again, right? If I buy another house, now I have two forms of cash flow, all going to pay off the policy loan, and I can pay off the policy loan twice as fast and 3 times as fast and so on and so forth. So this is how we bridge the gap. If we have a better financial strategy, We can use our money more productively, more aggressively, in a controlled way, but we can make our money do multiple things at the same time. So again, no matter who you are, no matter what stage of life you're in, this plan is one that will help you grow your wealth more efficiently. It is one that will give you more control and give you so much more confidence as you are growing your wealth, whether you're down here or up here or anywhere in between. This is a better way to grow your wealth. All right. That's it for webinar number 2. Join me in webinar number 3. And webinar number 3, I'm going to talk to you about how we transition from here into retirement and use our policy as a source of income. Okay? So join me in webinar number 3. Appreciate you taking the time, and we'll talk to you then.